As of 9 o'clock this morning, only 3 FTSE 100 stocks were down, and one of them was Marks & Spencer, which pretty much tells you all you need to know about what the market thinks of today's first quarter trading update. M&S was down by nearly 1.5%, even as the FTSE 100 was up by 1.5%, with only precious metal miners Fresnillo and Randgold Resources joining the retailer in negative territory. M&S's home and clothing operations saw sales fall by 8.9% on a like-for-like basis in Q1, and that drop comes after declines in the first quarter of each of the last 3 years, so the base for comparison was hardly difficult. Sales growth at the M&S.com website slowed to 0.5% in total, while on a like-for-like basis even food fell by 0.9% year on year, even if this represented what Rowe noted was clearly outperformance of a deflationary market. The only good news today is that Mr. Rowe, the boss, has not changed the firm's profit guidance for the full year. Poor weather, the timing of Easter, a delayed summer sale, and a strategic shift to reduce reliance on price promotions have all contributed to the weak figures, and CEO Steve Rowe is putting on a brave face today. But the numbers do underline the size of the challenge ahead of him, as all retailers do their best to satisfy internet-savvy, price-conscious consumers at a time when the lower pound and living wage may start to actually drive costs higher. Perhaps the best news, again, is that unchanged guidance, but in the end M&S made £690 million excluding one-off charges in other items last year. Analysts expect £624 for this year and £643 million for next, numbers which would mean the firm is actually earning less in 2 years' time than it did in 2005-06, if the forecasts prove correct. The question for investors now is what to do with the stock. The shares have already been hammered, sliding from a high of 5.50 to 2.93 in the last 12 months. That plunge puts them on a forward price earnings ratio of about 9 times, according to consensus forecasts, while the combination of a regular dividend and a special of 4.6p a share offers a total of 21.3p, according to the analysts, equivalent to a yield of 7.3%, enough to put M&S in the list of the 10 highest yielders in the FTSE 100. The show of faith with the special divvy is clearly welcome, but it does leave dividend cover thinner than ideal at 1.5 times. 2 would give greater comfort. So, any investor looking at M&S today needs to research the balance sheet and cash flow to make sure those payments are reliable, and do so in the knowledge that M&S cut its shareholder payout in each of 2008 and 2009. That's not to say this will happen again now, or that the market's current fears of a recession will prove to be accurate. We're just going to have to wait and see. But anyone looking for a potential bargain with M&S needs to do their own research first, checking out the finances and reassuring themselves that Rowe's strategy is sufficient to reinforce M&S's competitive position in what remains a very difficult marketplace today.